If you're going to accept a higher reward, then you have to accept with that a consequence, which is a movement in price. And it happens in property, it happens in shares, it happens in bonds.
Hi, I'm Mark Classic from Accounting Professionals, and welcome to episode 3 of our Beyond the Balance Sheet podcast. Today I'll be catching up with Tony Bates from One Wealth for part 2 of our conversation, and later be joined by Cameron Daly, Senior Manager at Accounting Professionals. All right, welcome back, Tony Bates, to the Beyond the Balance Sheet podcast. For those that tuned into the last podcast, we spoke, Tony, about the benefits of a financial plan and the considerations that need to go into preparing a financial plan. Today we're going to talk in a little bit more detail about one component of that broader financial plan, which is the investment piece.
The fun piece.
and I guess investments and investment advice in specifically is what people sort of gravitate to when they think of a financial planner or a financial plan. We spoke in the last episode that a financial plan is far more broader than that, but I think it's a good idea to elaborate in more detail about the investment strategy side of things.
Yeah.
And to kick things off, I guess, what's the starting point for advising a client as to the appropriate investments?
Yeah, so often it's about what's the money for, and it could be about the time horizon. Is it a today pot of money, or is it for the long term? Is it for super? Is it going to be geared? What structure is it going to be in? So the time horizon and the purpose is critical. There's no point in putting money with an investment advisor for 3 months and put it in the share market if you're planning to use it to buy a property down the track. So the time horizon is important, and then the other piece, the two key pieces are that and the client's own risk tolerance. And risk tolerance is about how you sleep at night. It's about whether or not you're going to watch it, whether or not you're going to worry about it, and how you make financial decisions and how confident you are about those financial decisions. So most Australians are roughly what we call balanced in their risk tolerance, and so they'll accept some downside risk in the short term as long as they know the longer term outcome is going to be great. But for people who aren't, people who are very conservative or people who are very aggressive, is the terminology we use, then the strategy will be different for those people.
Yeah, and part of that is to fill in the risk profile questionnaire.
Yeah, we have a questionnaire I've been using for 30 years. It is a good questionnaire, but it's only as good as the conversation that comes from it. It looks at not just investments, but it looks at how you make financial decisions and how you feel about those things. For me, it's a conversation starter. Before I came across the financial health check, it was my conversation starter. I used it for the first 15 years of my career before I met the client, because it is a really valuable conversation to have. And in a couple, you might have one person who's quite conservative, one person who's quite aggressive. And it's where those differences lie, where in that family you can make really sensible compromises and really good financial choices, even with those differences.
Yes. And when you're formulating a portfolio or constructing a portfolio, there's a requirement for you to take into consiration the risk profile.
Yeah, legally,
of your
it's a legal obligation. Some people take that obligation down to 3 questions. I prefer 25, but I actually prefer to have the conversation and the education, because one of the questions is, would you start to feel uncomfortable if your whole portfolio, your whole wealth fell by 5%, 10%, 20%, 33%? Most people come up with 10 or 20%. And we say that's going to happen. That is actually going to happen. And what do we do when that happens? How will we behave? And I find my role is most valuable when that happens. Not if that happens, but when that happens. Yeah. And so my level of communication with clients tends to be higher when that happens. And it's just part of the nature of investing. If you're going to accept a higher reward, then you have to accept with that a consequence, which is a movement in price. And it happens in property, it happens in shares, it happens in bonds. We don't see it as frequently or as dramatically often in the property market, but it does happen. And having a diversification between shares and property and equities, or I actually prefer to call it interest payments, rent payments and dividends, having that diversification of your income streams is what protects you against making bad decisions when the markets are difficult.
Yeah, and interestingly, we'll sit down with clients and they often disagree with their score in their risk profile, and it becomes quite a shock to them. But once you start having that conversation, you do get an understanding that yes, they are quite conservative, although they might think they're not,
and vice versa. And as I said, it's a point in time, that score, but I find that doesn't change even through life circumstances. Your actual innate tolerance for risk doesn't change through your life. Your capacity to take on risk, your choices might be different with circumstances, but your natural tolerance doesn't change very much. But it is quite educational to do this process. But I also find that you've got to go through the difficult period, and have that conversation about how you're feeling. And more often than not, the clients will stare me straight back. No, I don't look at it. You told me not to. And that's the right approach. The right approach is not to sell in and panic. The right approach is to ride it out, because it will always recover.
Yeah, and I think that's played out any number of times over the last, say, 20 years.
Yes.
We probably saw it first in the GFC, where there was some panic selling,
yes,
and a lot of people sold at the bottom of the market and took a long time to recover. I think more recently, when the market bounced during COVID, there was less of that panic selling.
I think people were more worried about their health than that. We actually had meetings in this very room, I remember, and I said, are you worried? I'm asking my traditional questions, are you down 15%? How are you feeling? Oh, actually, I'm more worried about the end of the world as we know it. But some market downturns can be quite prolonged, and it can be quite difficult.
Yeah.
And it's still the right advice to hang in there. You've often heard, and clients have heard, my rule of 72.
I was just going to go
and,
there.
And a 9% return will double in 8 years. 8 9s are 72. A 6% return will double in 12 years. You go to cash and get 2%, it'll take 36 years to get back to where you were. So it's the wrong advice to cash in. It is about that sleep at night. It is about that reassurance that markets always recover. And look, for the more playful amongst my client base, the more active, it's a buying opportunity, not a selling opportunity.
Yeah. So when it comes to constructing the portfolio, do you have a preference towards a particular asset class?
I decided early in my career that every Australian was an expert on property, and I felt that shares and bonds were more confusing for people, and so I could add more value. But I am actually very indifferent on rent and dividends and interest. I love the idea of business ownership, and I particularly love the tax system on share ownership relative to property ownership. But it's not a natural bias for business ownership over property ownership. I just find that Australians are more expert than me on that property in that town, and so I find I can add more value in shares and bonds. And what I often encourage is, if you love property and your whole wealth is tied up in property, use the cash flow from the property to build a pot of money. I call it a safe pot of money in shares, because there is an advantage of shares over property, and that is you don't have to sell a bedroom if you get caught. You just sell $10,000 worth of shares.
And that's sort of going back to your previous comment. You spoke about shares, but you also spoke about buying businesses. And that's effectively what buying a share is. Maybe
100%.
not to think about it as shares, but think about it as I'm buying a business.
One of my early employers, Macquarie Bank, I was allowed to buy shares in my own employer. And my dad was a share owner, and he talked business. And one of my first stockbrokers that I worked with was a storyteller about businesses. It is owning a business with employees. And here down in Shell Harbour, how many clients have we seen that own BlueScope and BHP?
Yep.
I mean, they're shares and they're an investment, but at the heart of it, they're a business.
Yeah.
And I love talking business.
Yeah. And that's the thing, people have an affinity towards property because they can go out and
Touch
see
the
it
bricks.
and touch it, whereas they can't go out and see and touch a share, but they can go and shop at a business, shop at a Woolies, or
100.
go to a bank or whatever the case.
The biggest 7 companies in Australia are all household names. BHP and Telstra and the banks. These are household names and very familiar to you. And if you don't like Telstra's service, don't own the shares.
Yep. And that's probably a good segue into my next point about building a portfolio. There are a number of clients that have their portfolios built around ethical requirements.
Yeah, look, I learnt early. I had a second generation wealthy inheritor with $20 million, and I wrote a financial plan for her, and she said, how's this going to save the planet? And I hadn't asked the right question. So I actually have a really simple question that I ask, which is there any investments you prefer to avoid? And that could be property. That could be anything. But it usually, if you just ask that one question, it will trigger potentially an ethical question. And I've been dealing in the ethical or responsible investment market all my career. About $1 in 8 is invested ethically, and that's been a consistent through my career. So it's not for everybody.
Yeah.
And often, sorry, I was just going to say, often the business owner wants to make as much money as possible to be philanthropic, but doesn't necessarily want to invest ethically because that's not how they've thought. But the next generation that I've found does.
So what would be an example of an ethical portfolio?
Well, I do two things. I do a smaller portfolio of things that what we call positive screening, where you're actually looking for companies that are going to do good things for the planet. For example, renewable energy, just as one illustration, or batteries. The second is what we call a negative screen. So we're looking at, say, the big four banks, and we say we want to own banks, but which bank has behaved better, which has got a better environmental rating or social or governance. We have a system of ESG in this country. We've got to be careful about greenwashing, but what I find is that the money that's the today pot tends to be the latter of those two, sifting out bad behaviours, but making sure we have big, ugly companies that pay dividends. Whereas for the superannuation money that we don't need for many, many years, we might invest in some of these smaller businesses that may not be at a dividend stage yet. I find that clients are quite happy to invest their very long-term money to save the planet.
Yeah. So just talking about that mix between dividends and growth, obviously the portfolio changes over time depending on the requirements of the client.
Yeah. There's an old adage in my industry that says 80-20. If you're 80, you should have 20% in equities and 80% in bonds. And if you're 20, you should have 80% in equities and 20% in bonds. I don't buy that, because when the money is not necessarily about retirement date, it's actually about the rest of your life and potentially a legacy. So if you've got a risk tolerance for shares, I intend to stay invested in the share market. But income does become more important when you are retired. And I'd say that your super fund or your investments is your pay packet. Mm-hmm. And so reliable, resilient income on an after-tax basis landing in the bank account, that's where I put my focus. And I actually show the cash statement more than I show the investment performance statement. Because what you want is your income to rise every year, like you're getting a pay rise as if you're working. And if you're buying good businesses or good properties, rents and dividends rise.
Yeah. And in today's environment, that money has to last a lot longer than what it did, say, 20 or 30 years ago.
That's true, but also we try and target a number where we're not spending the capital. Mm-hmm. There's a lot of research saying Australians aren't spending their super; they're actually leaving it as a legacy, and that wasn't the intention. And as you know, the payments, the minimum payments legislated, have to go up as you get closer to 100. But we're fortunate in Australia that our dividend payouts are pretty good. So the minimum pension is met. If you own a reasonable amount of shares and a good rental, you can probably get your 4 or 5% income, and that meets the pension payments.
And that's going to have to last for 20, 25,
yeah, that's
30,
exactly right. That's
third trimester, as you mentioned.
Yeah,
previously.
and so you want to pick businesses that you know are going to be around, or properties that you know are going to be in the right spot in 20 years to go. So you're not actually thinking about today's price movement. You're thinking about, is this business or is that property going to collect income in 5 years, 10 years from now?
Yeah. All right. Well, thanks for joining us for the second time, Tony. This is part 2 of our chat in relation to all things financial planning. I think probably you're sitting in on the appointments that we have with clients. I get to hear lots of your little insights.
I didn't get to go on the whiteboard. Normally I'd enjoy the whiteboard, but I do like talking investments.
But I think for me, the rule of 72, that's the most relevant one. And it is that classic trade-off between risk and reward.
Correct.
And arguably as a younger person, you can afford to take more risk.
Yeah, and importantly on that, there's moments in time where people are quoting 20% returns. It doesn't exist. It exists in the short term, it doesn't exist over the long term.
Yeah.
So managing expectations around that 8s and 9s is important, because that's basically inflation plus a reward for taking on risk.
Yeah. All right. Thanks for joining us, Tony.
My pleasure.
We'll look to catch up down the track.
Thanks, Mark.
See ya. Welcome, Cam, to the podcast.
Thank you. It's an honour to be here.
Thank you.
Yes.
So, Cam, you've been at Accounting Professionals for over 11 years now.
Yep. Not quite 11 years, 10 and a bit years, but I'm going to say this is probably the greatest honour I've had at Accounting Professionals. Being on this podcast.
It's turned into a comedy routine, has it?
We'll see. We'll see.
So you're a chartered accountant. You're one of the
Yes.
senior managers
Yep.
here at Accounting Professionals. Can you
Yep.
just tell us a little bit about how you arrived to where you are today?
Yeah, it's been a journey. So I got the job. So it was 2014, and I was overseas travelling at the time. So I was doing a few months backpacking through Southeast Asia. So my mother actually applied for the job for me without telling me. And then she just said, you got this interview at this date. And I was like, all right, no worries. So I was in a little hostel backpackers in Vietnam, and I had one of the iPhones and just popped it in a cup for the amplify the sound. Then I did an interview with Angela and Debbie, and I got the job, and that was back in 2014. I started January 2015. So I was at university at the time. So I was doing an undergraduate degree, Bachelor of Commerce, majoring in accountancy. And then went through, graduated into 2016, and then I guess I probably had 6 months off study, did a bit of a Europe trip while I was still working here, just a 6-week Europe trip, which was a bit of fun. Then I came back and I started my CA program, and that's about a 2-year program. So finished up in 2019, got my full CA, and I've been a senior manager ever since then. So it's been a really great journey, and Accounting Professionals has really kind of pushed me through.
You're also now, you've got responsibility for a team and bringing I guess the next generation of accountants in our office along.
Yeah, I take that really take a lot of personal responsibility for that, because I reflect back, and like yourself and Nick Fitzgerald, you guys did a lot for me to bring me up, and now I kind of see it as my responsibility to bring the next generation up. So I've got a great little team that, that's kind of in my division, like great team broadly speaking, but also just in my kind of pod. So, yourself, you head up our pod, and then, you've got me as the senior manager, and then below us, Zach is kind of like the junior accountant in the team, and, he's doing a great job. He's coming along really well. And Lynette, she's, fantastic. People person. She's got great kind of soft skills, and all the clients love her, and all the team love her here too. So she's fantastic to work with. And then we've also got Arlen overseas, who I'm not sure if the clients would know Arlen too well, but he's a superstar. Yeah, he's just fantastic, and can't speak highly enough of him. He's really respectful, really knowledgeable, and he's been with us for about 8 years now as well.
And you mentioned Zach, and you speak very highly of Zach. For those people that haven't caught episode 2 of the podcast, Zach was our guest. So if you'd like to know a little bit more about Zach, maybe check that one out. I guess you sort of mentioned working with clients, and I think amongst your client base, you're fortunate that you've got quite a diverse range of clients, which gives you an opportunity to get involved in lots of different matters. What sort of things are you sort of working on at the moment? Like you said,
Lots of clients, so it gives me a lot of opportunities, and kind of at the moment, like a real kind of, not necessarily a focus area, but a few things we've got going on is around business sales and around business purchases. So obviously the life cycle of businesses, they all have to start somewhere, and they all have to end somewhere. So that's kind of the two ends of the spectrum. So got a few matters on at the moment of clients looking to purchase business, and also clients selling the businesses, and that's very kind of interesting work to deal with.
So as part of your role, or as part of our role as the practice itself in helping clients, whether it be a purchase of a business or a sale of a business, how do we get involved in that process?
I'll start with, say, a business sale, because we've got a few of them on at the moment. So it's really, the step one is working with the business owners, and kind of really getting their goals. So we work closely with our clients, and the first thing is developing a business plan, a want of a better word, like a 5-year kind of plan. So what's like where do you want to be in 5 years' time? Where do you want to be in 12 months' time? What are your goals for 12 months' time? What are your goals for 90 days? What's the actions to achieve that? So Say for a lot of our clients who are, entering, the 50s, their 60s, they're looking to exit the business. Their 5-year plan would be, I want to transition out of the business within a 5-year span. So then our quarterly coaching and everything like that is geared around what do we need to do to set up the business for sale, both from a taxation perspective and also just a practical perspective. From a business purchaser's perspective, we conduct what's called a due diligence exercise. So we look at assessment of the business viability. We have quite an extensive checklist that we work through, and basically we just kind of want to make an assessment of, is the business a fair market value for what you're going to pay for it? Is there any kind of skeletons that we don't know about?
So often, I think when we're working with clients, there's maybe an underappreciation or maybe not so much of an understanding about how long it actually takes to prepare a business for sale.
Yeah.
What are some of the things that we would work with a client on in preparing their business for sale?
Yeah. So I think the key part of it is that it's actually a business for sale, and we got to really separate the person from the business. So all too common in small businesses, it's very key person dependent or key people dependent. So we kind of want to we refer to it as kind of the 10 hats of the business: people, finance functions, marketing functions. You can help me out here, but all the different functions of the business, we want to make sure that a person's responsible for it, and there's a kind of a team underneath that. So we want the person who's going to buy the business, we want them to be confident that it's a turnkey operation where the old business owner can walk out and the business can keep on functioning as normal.
Yeah, and that certainly de-risks the transaction. And often a lot of businesses, the value of a lot of businesses are tied up in the owner. And from a purchaser's point of view, obviously that's not ideal. So making sure the business is structured in a way that it can operate without the owner, as you mentioned, is really important. So I guess one of the important parts of us advising clients in that space is advising them around the structure of the sale, and with sort of consideration to the commercial aspects, but also the taxation aspects.
Yeah, so the structuring of a sale of a small business from like you mentioned, a commercial aspect and a tax aspect are very important. So examples from a commercial aspect is you're purchasing or is the buyer purchasing the company, is it purchasing the business? From a tax perspective, there's a lot of what's called small business capital gains concessions available or potentially available, which have a massive material impact on the amount of tax that you have to pay on the sale. So in some instances, they can completely mean that there's no tax to pay. So the 15-year retirement exemption, for instance, and then there's other active asset discounts and whatnot that are available to small businesses. But the kind of criteria is quite stringent around that, and we need to make sure we get the transaction right. Otherwise, it could have a really big kind of tax outcome. So it could be from paying $0 of tax to paying tax at 47%, which can obviously leads into the retirement planning.
And when it comes to structuring the sale, I think we look at it as a team effort. So we're working with the client, but there are also other professionals that we need to get involved.
Yeah.
And often that might include a finance expert that's helping to source funding. But probably most commonly we work with legal practitioners around making sure we're getting the documentation right around the sale.
Yeah, so the thing with legal professionals is we kind of so we'll review the share sale agreement or the sale agreement and whatnot, and I guess read through the legalese and put it into the kind of client's terms, and we want to make sure the deal as structured on paper is translating into the legal document. So that's where we kind of come on board and work closely with both in conjunction with the clients and with the solicitors as well, to make sure basically that the nuts and bolts of the deal is reflecting in the actual sale contract, because sometimes they can be quite different just with the legal speaking.
And then I guess the final piece to the process is we've ticked all those boxes along the way to get to where we've got to, and the client's either successfully sold the business or purchased the business. And I guess that's the next part of the process is helping them work through. And for a lot of people, it's the first time they've owned a business. So we've got a role to play on that front as well.
Yeah, previously speaking, if you've just recently bought a business but you've never been a business owner before, like you have to, it's a separate job compared to what you used to. So there's a good book out there I think I recommend anyone listening to. It's called the E-Myth. So the E-Myth uses the example of, say, a baker. That they like to do baking, so then they bought a bakery, but then they thought they can just continue on as a baker. But in reality, now that they're a business owner, and it's completely separate to a baker. So you really need to break down the technical component and the entrepreneur component, and you can't neglect either of them. So there's a tendency for a person to say buy a bakery and think they're a baker, but no, you're actually a business owner now. So you kind of really got to reposition your thinking around that, and that's where we kind of come in and offer the coaching kind of aspect. So monthly or quarterly coaching is advising the clients and giving them a baseline financial education and also an education regarding business ownership. The advantage that we have is that we operate in magnitude of different industries, and they all kind of have common themes. Everyone has employees, everyone has products or services or anything like that. So it's, even if it's completely different industries, even if it's a baker or an engineer, there's definitely the commonalities there.
Well, that's a very comprehensive rundown of how we work with clients, and I guess to put an exclamation mark on that last point, that the real fun starts once they've purchased the business. There's a whole lot of work that gets done prior to taking over, but then the real fun and games start once they do take over. So for those out there listening that may be contemplating, say buying a business, for example, what's the one piece of advice that you could give them?
Yeah, one piece of advice would be that you are purchasing a business, you're not purchasing a job, and you got to really think of it, separate the what you're doing to being a business owner. So being a business owner has its own kind of different sets of challenges, but you get the rewards as well. So be mindful of that.
And I think, just to add to that, I think for what it's worth, for my one tip to people looking at purchasing a business is you don't have to purchase the first business that you look at. We would say, when we go through the process that you've just spoken about, we would say no to purchasing a business more often than what we would say yes to. And in the long run, that's, I think, where the value is. Because, as you said, it's not just losing your initial upfront investment, it's those losses that you might incur after that. So take your time. There'll be plenty of businesses that will come along. Let's make sure you get it right. All right, thanks for joining us today, Cam. Thanks for taking the time out of your busy day. And I'm sure that everyone will gain some really good insight as to the topics that you've raised. So thank you.
Thank you.
Well, that wraps up episode 3. We hope you can join us for episode 4 of Beyond the Balance Sheet next month. See you then.